the day after the union budget. So incredibly resilient market is what we had yesterday. I was saying this in the afternoon yesterday that if you'd basically been given what was going to happen in the budget, I mean 2 days before, and you would have you were asked what would the market do, how many would have said, well, the market does nothing, it's absolutely flat and just moves on, right? I think that's the power of local flows, retail flows, which have come through. So there are changes on your screen. There was a bit of a swoon, absolutely. The Nifty fell about 400 points and then, of course, spent the rest of the day recovering. This is interesting because the India wicks, because if you're thinking about, well, yesterday was just one day and now we'll see the real reaction on day two and over the next couple of days. The India wicks fell 18% yesterday to about 12.75. And typically, unless the wicks is showing you, is flashing 17, 18, 20, you're not expecting big moves one way or the other. So that's the reason why I'm saying that should not expect any dramatic day two moves different from what we had in terms of yesterday as well. So sometimes it is absolutely reasonable to expect that, day one, on the day zero is something, and then, of course, the real reaction comes through. It's happened. But I think that looking at the weeks, I don't think one can make the case here. Now, you have the budget, as I said, which did not really add or take away too much from the market, ex the capital gains tax changes. I mean, you look at Capex, which was unchanged, and tax revenues. I mean, it was largely very little changes compared to what was put out in the interim budget, except maybe things on gold. And we'll talk about specific things here and there. But otherwise, at a broad level, ex taxes, there wasn't very much which it did for the market or took away from the market. Overnight global cues are absolutely flat. S&P is down about 0.16%. But the small cap rally is back. And the Russell 2000, it was a very nascent move towards the first half of last week. It fizzled out, but the Russell is back up 1% on a day when the S&P and the Nasdaq were slightly lower. 10-year unchanged, 4.25. Dollar index near 104.5. Oil has ended near the 200-week moving average. It's an important support level. We left off at about 81.56, and I think we are... that's, I think, 10 cents here or there compared to the 200 weekly moving average. Now, Tesla reported numbers after market hours, and the stock reaction is telling. Stock was down about 7-8%, even compared to consensus. I mean, so market street expectations of subdued numbers. The numbers are a bit of a miss. Let's circle back to levels then, right? So you have the Nifty, which ended well above the 20-day moving average of 24,312. After hitting a low of 24,074. So that's the kind of recovery that we are sort of talking about. We need to break above. I mean, essentially, if the direction of travel is upwards, you basically have to see the market taking out the earlier highs, which is 24,854. Not very far away either, right? A couple of percentage points to be able to resume the journey higher. Bank Nifty nearly hit the 40-day exponential moving average at yesterday's low of 51,290. Correction on the Bank Nifty. I mean, we'll put out the chart later as well. It's like the correction is from a falling channel. So, you get out of that channel, and I think market starts to respond positively. And that level there will be 52,650 for the Nifty Bank as well. GIFT Nifty will come up on your screen telling you what the start is going to look like. It's about 50-odd points lower, a slight... I think we'll look at this in 5 or 10 minutes or so. I think the rate perhaps is showing. Is the rate slightly wrong, and we'll revisit this in a bit from now. But as I said, don't expect anything dramatically different in the market on day two as compared to what we've seen in trade yesterday. Sonia.
Absolutely. I think, the market has no choice but to move on from the budget, right? Of course, there is going to be that lingering negative impact because of the budget, because of higher taxes that you'd have to pay. But we're going to move on and talk about some of the stocks that are in the news this morning and, things that you need to watch out for. So let's get straight to it. Consumption stocks are going to be on my radar today because of the kind of valuation headroom that they have, because of the kind of earnings that have come through. HUL's earnings, honestly, were not bad. They were largely in line with estimates. And, if you look at something like a United Spirits, the earnings were actually quite decent. It was a strong operational beat that United Spirits has seen. ITC, in any case, is sitting at a fresh 52-week high. There's been a lot of contribution from there. So this entire consumption piece is something that I reckon could continue to move to the forefront, given the earnings. On the flip side, Bajaj Finance could really disappoint today because of the weak set of numbers that the company posted. The core earnings missed expectations. A lot of brokerages have cut their earnings estimates on the stock. Citi, in fact, has cut their target price to 8,275, which is still well above the current market price, but they believe that the numbers were quite weak and the way forward could be disappointing as well. Yesterday, after a very long time, foreign investors sold in the cash market. So that is something that, is a bit worrying for me. Almost 3,000 crores of selling. And of course, you've seen the US markets under pressure as well, led by tech stocks on the downside. So it's a given that today the market will open in the red. But remember, you are going to have to pay higher taxes. So the best thing to do now is to just find stocks that can perhaps outperform the markets, because you're going to have to pay that extra 12.5% in any case. So I think that makes our work a little, more important, given that this is a market which in any case is very hard to find, stocks where there's valuation upside.
So extra 20%. 10 to 12.5 and extra 33% from
15 to 20.
15 to 20.
Yeah.
So, I mean, actually, in percentage terms, it is... but anyway, as you said, just work harder. I mean, there's no other choice.
There's no other choice. You can cry over it or you can move on, right?
Well, that's right. The markets actually took this in our stride, right? So yesterday's reaction was fairly good. I mean, if you told me that we're going to be hiking capital gains and then you went flattish, wow, you would grab it with both hands. But I just want to recap and see in 2018, when at that point of time, the finance minister had introduced LTCJ again for the first time, after a while, of around 10%. On that day as well, the markets ended more or less untouched. It was more or less flattish. In the next 45 days or 35 sessions, so to call it, we had the markets correct by close to around, roughly around 10% or thereabouts. That's the kind of reaction that we saw post the budget in the next 35 sessions. By the end of the year, though, we recovered a fair bit. Now, though we are saying that in the next 35 days, there was a downtick on the Nifty, I'll tell you what, for the broader markets, there was a prolonged period of pain for the next 1 year to around 18 months or thereabouts. So the broader markets took a harder hit. This time around as well, we have taken it in our stride. But in the near term, I'll be looking at, what the index does and also the broader markets, because that's where you made the majority of the money. What about the FI flows? Well, I'll be looking at that closely as well. As Sonia mentioned, they sold yesterday and a largest chunk. And I'll be watching them because they just come back into our markets. For year to date, we have a positive number coming in for the FIs into the Indian markets. But just till last month, actually, that number was negative. So they just started turning around. And then, in fact, we have this piece of news in terms of higher taxation. So we'll be watching that. And also the other emerging markets, actually, in the last 30 days, India has got bulk of the FI flows. And the other two actually haven't got that much. What about our own FNOQs? Yesterday, there was some unwinding of positions on the Nifty Bank. Remember, some part of that will be a rollover as well, because we'll have the monthly expiry that will be playing out. But if you're looking at, the FI data points, the long positions came down by close to around 35,000 contracts, or the short contracts went up by around 20,000 contracts. And after the while, the FI short positions have moved to around 26%. Actually, the next chart will give you a better picture. The FI long positions is actually the lowest we've seen in this series. It's come down to around 2.8 lakh contracts. A few sessions ago, it was at around 3.8 lakh contracts. So the FI long positions have come down substantially. And the client short positions as well, there has been some covering out there, because that as well has come down to around 1.2 lakh contracts, which is the lowest we've seen in this series. So both of them, they have covered their positions on their respective sides. The options data, the PCR is coming back down to the lower end of the range. Yesterday, it went down to around 0.87 odd. Remember, normally it bottoms out at around 0.7. How did this happen? There was aggressive call writing, the 24,500 call, 24,600 call. Both of them added close to around 45 lakh shares out there. But what's giving you some hope is there was some writing even on the put side at around the 24,400 put. Which brings us to the levels. Yesterday's low, both on the Nifty as well as Nifty Bank, become extremely important. So that comes up for you on the screen. A reference point as well will be the 20 DMA on the Nifty, which is at around the 24,300 odd. I've given you the support levels because that's going to be more important in the near term. For the Nifty Bank, yesterday's low was at around 51,300. That's an important mark to look at. And you'll be feeling confident on the Nifty Bank once you get past the 20 DMA, which becomes a bit of a near-term resistance zone. So as of now, we ended at around the 51,800 odd mark, but those are the crucial levels that we are looking at, Sonia.
Okay, well, doesn't look like it's going to be a very good start, but let's see. We'll take it as it comes. First up on the equities front, we have lots of opinion coming through on the markets and, the post-budget situation as well. Vikas Jain of CLSA says the budget saw the government's big focus on fiscal consolidation, as FY25 fiscal deficit was budgeted at 4.9% versus 5.1% in the interim budget. And the plan to bring it down to 4.5% in FY26 was reiterated. He says with a clear focus on job generation, the government revealed a new employment subsidy which should also aid low-end discretionary consumption. He says a hike in both short-term and long-term taxes on equity is a clear negative, while the removal of inflation indexation will surely reduce investment attractiveness of premium real estate. He says no change in capex estimates versus interim budget may be a disappointment for investment-linked stocks, which have seen a large rally in the last 9 months.
Okay, this is Venugopal Garre of Bernstein, who believes that budget was a neutral event and what transpired was not entirely unexpected. He says capital gains tax increase is also a non-event. He sees Nifty at a fair value and have witnessed some heavyweight misses in recent earnings. He adds small and mid caps are rich in valuations, which should be potentially impacted as primary market fundraising accelerates. He remains selective overall and continues to have stock picks.
Okay, and let's get you some money market views. Kunal Sodhani of Shinhan Bank says the rupee dropped to a record low against the US dollar, pressured by the drop in local equities after the government proposed raising the tax rate on capital gains. He says a weak Chinese yuan also is putting some pressure on the rupee. The dollar index seems to be consolidating and awaiting the US PCE data for the USD INR. He says 83.55 acts as a support, while 83.73 acts as an immediate resistance, and if broken, then some stops may be triggered and move towards 83.85 levels could be seen.
All right, well, those are lots of views coming in. Let's get some more. Taimur Beg is Managing Director and Chief Economist at DBS Research Group. Taimur, good to have you with us here. Thank you very much for your time. Appreciate it. So what's the verdict for the budget? Does it move the needle either which way from a financial market point of view, Taimur?
I think from a bond market point of view, it's relatively constructive. I'm not really sure about the equity market, given the points that were just raised in your earlier piece, that between the pressure on EMFX, as well as the arguably high valuation of the Indian equity markets, the long-term capital gains may well be a bit of a cold water on the financial market outlook as far as equities are concerned. But credit and bonds, in my view, are neutral to positive out of this budget. The budget is playing the long game, focus on the supply side, do things to boost productivity, both on the labor side and the capital side. And that should be good for growth. That should be good for fiscal. Key issue is, bond supply. And I think that keeping the deficit below 6% of GDP was very welcome.
Taimur, hi, good morning. So you're talking about the positives, right? In terms of consumption, do you think enough was done to boost both rural and urban consumption? Because given the way taxes have been hiked, it looks like it's going to hit the middle class for sure. But do you think enough measures were taken by the government to sort of boost rural and urban consumption?
So I think if we look at the totality of the fiscal measures over the last half a decade, lots have been done to support the mid and the low end of the income spectrum in terms of welfare support. Therefore, I think that we should not expect every budget to sort of ratchet that up. Expenditure to GDP ratios have gone up. Debt GDP ratios are pretty high. We are heading into the world of higher for longer. I don't think this is the time to keep on adding fiscal outlays. I'm pleased to see that the authorities managed to pull off a fiscal arithmetic gymnastic in which no major expenditure item was really sacrificed. But I'm also pleased to see that nothing was ratcheted up substantially, because I think the bond markets worldwide, not just in India, are getting a bit stretched. So you got to be careful about the supply side. And therefore, to me, focusing on the long end of the game, just boost skills, boost productivity, that'll create jobs and income. And that's the right way of supporting the economy, not necessarily softs in the short term.
All right. Hi, Taimur. Good morning. Good to see you. When going by the fiscal prudence that the finance minister has stuck to, do you think India's case for a sovereign credit rating, better sovereign credit rating is on the cards? Has it made our case stronger?
Look at the credit ratings agencies. They remain a bit concerned on the primary deficit as well as the debt GDP ratio. It's going to be hard to pull off major progress in that area unless we see growth upwards of 7%. So that's my back of the envelope calculation, if you will, that for a credit rating upgrade, we would need a firm upwards above 7% forecast for GDP growth. That would help the various ratios, particularly debt service ratio, primary balance, and debt GDP. And that would then start making inroad into the spreadsheet of those credit ratings analysts, if you will, and start flashing marginally green. I think we would need those things before a proper upgrade is coming.
So there were expectations of a further expansion on things like the PLI manufacturing scheme, etc., Taimur, but none of that really showed up this time. Would you construe that as a negative?
No, I think if there were, additional incentives on top of all the incentives that has been provided so far in the last, say, 3 or 4 years, I would have seen that as a sign of worry that it is only about industrial policy and it's only about providing incentives to the sector and protecting it. I would like the sector in manufacturing to be privy to greater competition, recognizing that there are other large manufacturers out there who are very competitive, very productive, and SOPs will not get India into the global picture of manufacturing. It would be productivity and competitiveness, and that would not be driven by SOPs. So therefore, I think that some of the incentive schemes that are in place, in my view, are plenty.
Arvind Sanger is also with us, Taimur, so let's get him into the conversation. Managing partner at Geosphere Capital. Arvind, we spoke yesterday, and good to speak with you again today. So, I was saying in the morning that the WIX sold off yesterday. The India WIX was down some 18%. Sometimes on day zero of an event, the market reacts a certain way, and then as things start to seep in, it starts to sour a little bit, or move the other way. Are you expecting anything dramatically different today and over the next couple of days? Because yesterday was just, absolutely flat after all those tax changes.
Well, I guess let's be clear. Taxes on stocks went up, so we're not going to be jumping for joy for that. Let's be honest about that. And as far as the rest of the budget is concerned, I think fiscal consolidation is happening. That is good. If they're shooting for 4.9%, that's a good sign. There are some, other than the tax increases on capital gains for equity investors, there are, minor positives, minor negatives, but I don't think there was anything barn burner either direction that should cause, any meaningful change. I think, as Taimur, I think, was saying, I think the real challenge now is the private sector has been provided a lot of incentives through the PLI scheme. It has had a tax reduction to 25% a few years ago. Profitability has improved. The CapEx cycle, the baton has to be passed on from government doing all the heavy lifting to at some point the private sector coming in. And that's going to be, this budget wasn't going to dramatically change that. I think that's what we should see in the next leg of the story as it works out. So I think the budget was largely a non-event, except for a minor negative for stock investors.
There is a negative for real estate investors as well, right? While the long-term capital gains tax on property sales was reduced, now you won't get any indexation benefits when you sell your property, which you hold for over 24 months. What does this mean in terms of whether the money will now come to the equity markets? I'm just trying to understand what the ramifications of that would be, Arvind, on a market like equities.
Yeah, well, I think, look, the financialization of assets was happening anyway. I'm not sure that there was a huge amount of investment capital going into real estate, but to the extent that at the margin it's slightly negative for real estate, it could drive some. But, I think the equity inflows are coming anyway, so I'm not sure this is going to make a big, it's going to be a big catalyst for significant incremental, because I think real estate as an investment class was anyway not, at the top of investors' incremental allocation. So I think that part shouldn't be. And I think there's one other important point that they did. They did put in a lot of incentives for job creation, which is, I think, a pretty good thing, because one of the problems is job creation, but I'm not sure that incentives alone are the solution, because I think the skilling needed and to make sure that people are trained enough for the jobs that are, going to be offered if you're trying to grow manufacturing. That's also important. So it'll be interesting to see how all of that works out. But I think, in terms of real estate versus equity investors, I'm not sure that there's enough of a thing there to get really excited about. I think the long-term story budgets are, in my opinion, small, paths on the road to what makes us bullish about India long-term.
Sonia, on real estate, right? So for older, so the indexation is gone, right? So that tax impact is larger. That is the sort of understanding. But for further sales in real estate, isn't it a booster? Because if you're an investor and you're buying something now and you sell, you're not paying 20% after 24 months. Earlier, you were paying 20%. Now you're paying 12.5%. I'm saying for future sales.
But even for
from
future
here,
sales, you won't get indexation benefits, right?
no, but if you buy now and you sell within after 3 years, in any case the indexation is not
It's
that
not
much.
that much.
So actually for future sales for new projects, etc., this actually could be a booster for older legacy property which you already own, which you bought
to
in
sell.
2000 or whatever, right? I mean earlier, and you're selling because property values have gone up 10x, whatever. I mean, it could be a significant hit. Tax outgo could be much higher. But for future sales, I think it could be actually a booster. We'll sort of try and understand this with...
I think, Prashant, it's case to case.
Yeah.
For example, I was just doing the rough math for a property that my parents sold.
No,
and in
so
fact,
older is good. But now, if you do it now, from
now
today...
on, yeah.
Then
no,
it is...
I'm saying that argument, whether it was good or bad, the change, even if you bought it in early 2000, actually depends on case to case.
Then also it could be marginal.
Exactly.
It could be marginal.
Exactly.
But from here on, I think it's not negative. It actually could be positive from a developer point of view. Taimur and Arvind, great to have both of you here. Appreciate your time. We'll take a very quick commercial break here. We are back. Our research team will get you the top stocks to watch out for that's lined up in just a bit from now.
Well, it's day 2 after the union budget, and to be honest, the market is still trying to digest all that came out of the budget, especially the higher taxation that you'd have to pay on your listed shares, as well as, on things like property. But our research team is standing by to give you the list of top 10 stocks as we begin a brand new day of trade. You have so many companies that came out with their earnings, so let's get straight to that. HUL first up. Mangalam is here to tell us more. Mangalam, good morning.
Good morning. So FMCG was the sector of yesterday, could well be the sector of today as well, and that's because of HUL numbers, because in these numbers there are green shoots which are visible, probing one to ask whether the elephant is ready to dance now. What's good this time around is that the revenues have been a mild beat over street expectations, and it's the first mild beat that we've seen from HUL in the last many quarters. The EBITDA also, has seen a bit of a beat, and the home care business grew by about 5% as against street expectations of 2 to 3%. What did not do too well, beauty and wellness grew by about 3% versus 5 to 6% expectations. Food and refreshments were buoyed lower by Horlicks and Boost that were subdued performers. But volume growth of 4%, no one's complaining. Gross margins improved by 150 basis points, and personal care business as well did not fall beyond what was expected already. Management sees gradual recovery in rural demand, near zero price growth going forward, telling you that it will be only volume-led growth going forward, with EBITDA margins maintained at current levels. Their priority is to accelerate volume growth, strengthen competitiveness, and maintain healthy margins. So some aggression shown by Hindustan Unilever. See green on the stock.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across to Abhishek, who's here to tell us about Bajaj Finance's numbers. Morning, Abhishek.
calculation shows that the net interest margin has declined both YOY and quarter-on-quarter. So my calculation shows that there is a 50 basis point decline in net interest margin of Bajaj Finance on a YOY basis and about 25 basis point on a sequential basis. So this net interest margin could be one of the lowest that you are seeing in last 2-3 years or even more. So NII growth is at 24.5% YOY and about 4.4% sequentially. The other income boosted the top line growth. So net income was up 7.2% on a sequential basis. Provisions spiked up. They increased by more than 69% YOY and about 28.5% sequentially. That impacted the profitability, and profits grew by only 2.3% quarter-on-quarter. Take a look at the asset quality. The deterioration over there is very high when compared to Q1 versus Q4. This is the highest deterioration in Q1 that I am seeing for Bajaj Finance over the last 2 to 3 years. So gross NPA has increased by 8.5% in absolute value. Net NPA has increased by around 11% on a sequential basis, which suggests that the PCR calculation shows that the PCR has declined by 100 basis points. With reference to our poll, both the NII and PAT is lower than our poll. NII by 3.9% and PAT by 1.6%. Back to you.
All right, Abhishek, thank you very much for that. More numbers, right? ICICI Pru Life also reported earnings. Yash is here with details. Yash, morning.
Morning, Prashant. So, of course, for ICICI Prudential Life Insurance, the first quarter was a mixed bag, but with a very important positive bias which came in the numbers. I'll first just make you understand the numbers with respect to our poll. New business premium has come in line with CNBC TV18 poll. Total AP and VNB have missed estimates. Retail AP has come with a strong beat, and margin, that is the positive bias which I'm talking about, that has come in line with the estimates, and the street will be watching out for the margin number. Just to refresh the numbers in terms of year-on-year comparison, new business premium has seen a growth of 24%, total AP annualized premium equivalent growing at 34%. Retail AP, which came with a beat to our poll, is growing at 57% on a year-on-year basis. VNB growing at 8%, and the margins that I was talking about, the company has been able to derive margins of 24% as compared to 30% on a year-on-year basis. But margin is the number where the industry is seen, deterioration in the margin profile because of higher ULIP sales. ICICI Prudential Life has come up with inline margins, and that's the number which the street will be looking out for. The stock has rallied about 13% in the last 1 year, 12% in the last 3 months, trading at 1.9 times price to embedded value. So because of the margin number, there's still some runway, it seems like.
Okay, well, after the announcements that came from the budget yesterday, I'm sure some spirits were needed to get people going. Mangalam is here to tell us why you should be watching United Spirits this morning. Mangalam, over to you.
Well, it was a good operational performance that came in. It was a tough quarter for, the spirits industry, the outdoor consumption industry itself. But, in that, the company posted very good performance, especially on the EBITDA front, which came in at around 458 crores versus street expectations of 405 crores as well. This, even as the revenues at 2350 crores were largely in line. That took the margins closer to that 20% mark, much ahead of the management's guidance as well. And the net profit came in at around 300 crores versus expectations of 238 crores as well. What is it that led the revenue growth? It was the premium spirits. Prestige and above, revenues grew in double digits versus expectation of 8 to 9%. And that was led by volume growth of 5.1%. Again, the street was working with a number of 4 to 5% as well. So premium products doing better and popular products not doing so well has actually aided their margin. So we have value for the popular products declining by about 2.4% and volumes declining by about 4.6% as well. And additionally, they've gone ahead and made a couple of acquisitions as well. They've announced, around 2.3 crore acquisition, 2.3 crore investment in a non-alcoholic company called Sober, and also a company called Caffeine. They bought 25% stake. Caffeine makes specialty cold brew coffee liqueur. So interesting foray out there as well. See green on United Spirits.
Okay, Mangalam, thanks for that. Well, let's move to the pharma space. Then Ekta is here to tell us about Torrent as well as Dr. Reddy is. Ekta, morning.
Morning. Well, Torrent will be reacting to its numbers today. It came out post-markets. Revenue was it was an inline set of numbers. So revenue was up around 10-odd%. Margins 31.6%. Street was anticipating 31.4%. And profit at 457 crores versus our pool of 458 odd crores. Now, adjusted for one-off expenses, the margins came in at around 32.3% as per the company. Now, India did well. It was up 15%. Their chronic business, in fact, outperformed the market with a growth of 14%. Germany did well well. It was up around 10 odd %. US continues to be sluggish. It was 31 million versus 32 million Q-on-Q and versus estimates of 35 million. But they have indicated that there could be a pickup in the coming quarters in the US business, aided by 6 to 7 launches. So I expect Torrent Pharma to be in the green today on the back of their numbers. Dr. Reddy's will be in focus because on the 27th of July is when they will be meeting for their Q1 numbers. They will also be considering a stock split.
Okay, all right. Thanks a lot for that, Ekta. Well, I'm keeping an eye out on Vedanta. Yesterday, the stock actually was lower, but that was more to do with the global weakness that we saw in base metal prices. For the time being, the stock's in focus because the board will be meeting on July 26th for the second interim budget. The record date as well has been fixed as August 3rd. Now, a couple of alerts are there. They've already paid one dividend of close to around 11 rupees. That was in May 2024. And they're sitting on a good amount of liquidity because they've got 8,500 crores by the QIP route. So keep an eye out on the stock. Fundamentally as well, the stock is well placed, but prices, LME prices, need to be tracked. Well, let's go back to Abhishek. He's here to tell us about Mahindra & Mahindra Financial. The numbers came during market hours, but there were con call takeaways as well. Abhishek.
M&M Finance did report their P&L during market hours. However, the finer details came out in the presentation post-market, wherein the net interest margin looks to be the lowest in many quarters. It has come in at 6.6% versus 6.8% YOY and compared to 7.1% for the previous fiscal that they had, FY24. Now, I'm saying previous fiscal because they give cumulative net interest margin, that is Q1, H1, 9 months, and then fiscal. So there is a sharp decline in their net interest margin, and P&L is below pole. The NI is at 1,894 crore versus 1,910 crore of our pole, and the PAT has come in at 513 crore. We were working with a number of 520 crore. Another finer detail was with respect to the absolute value of gross NPA. Gross NPA in Q1 increased by 8.6% quarter-on-quarter, and net NPA increased by 18.5% quarter-on-quarter. So there is a sharp deterioration, unlike what you have seen in other few years. This is the highest gross NPA and net NPA deterioration that we have seen in Q1 of a fiscal. So PCR has declined. Provision coverage ratio, as per my calculation, is below 60% versus 63% in the previous quarter. Management has reiterated that they will maintain their credit cost at around 1.4%, and on the higher side, they will try and maintain the ROA of 2.2%. So if at all, I spoke to some analysts, they said if at all asset quality deteriorates, PCR of the entity could fall further. Back to you.
All right, Abhishek, thanks very much for that. So that's M&M Financial, which will also be reacting to earnings. Parag Milk is the other one we want to focus on. Mangalam is here with details on this one. Mangalam.
Well, after United Spirits results, everyone would say, Daru, what about Doodh? Doodh's doing actually a lot better because, the margin expansion for the dairy sector continues. If you look at Hatsun Agro, Dodla Dairy, Parag, all of them seeing gross margin expansion anywhere between 400 to 550 basis points, and that's reflected in Parag's numbers as well. The EBITDA is up 32% at a time, and the revenues are up just about 1.1%. Margins improving from 5.6% to 7.4%, and net profit up by 28% as well. They reported a 10% overall volume growth, and in that as well, premiumization has been working. Ghee, cheese, and all their new age businesses, which is protein and value-added milk, etc., growing between the tune of 15, 12, and 51% as well. All these things working for them, along with reducing milk procurement prices as well. So, same time last year, milk was procured by them at around 38 rupees per litre, now down to 31 rupees, which is a decline both quarter-on-quarter and year-on-year. This is a positive, especially because last quarter there was a mild blip in milk procurement prices, making people wonder if the dairy cycle is turning, but turns out that not yet, it is still positive.
Okay, Mangalam, thanks for that. Well, let's go to Vamakshi and wind this down with Shuffler India. Vamakshi, morning.
Well, good morning, Nigel. A good set of numbers is what the company has reported this time around. Revenue saw an uptick of almost 15% on a YOY basis, and this has come in higher than what analysts were expecting. And this growth in revenue is largely being led by bearings and industrial solutions as well as vehicle lifetime solutions, both of which were up nearly 18%. But the cost of goods sold were much higher as compared to the revenues, growing by almost 17%, and resultantly we saw a contraction of nearly 90 basis points in the gross profit margins, and gross profit was up nearly 13%. EBITDA came in higher than what the street was expecting, growing by almost 10% YOY, and the margins, however, saw a contraction of nearly 84 basis points. Net profit, however, came in line with what the street was expecting, nearly 3%. 1% higher. Overall, it looks like a good set of numbers with revenue EBITDA above estimates, EBITDA margin slightly below, but the net profit is in line with what the street was expecting, and resultantly, I expect the stock to open higher today.
Okay, thanks a lot for that. So those are some stocks to watch out for. But let's also find out what's happening in the world of commodities, because clearly there's a lot happening over there. Oil prices have been rising as US crude and fuel inventories are seen shrinking. So Manisha Gupta is here to give us the latest on that. Manisha, over to you.
Thank you for that, Sonia. Well, yes, some bit of an increase in crude oil prices, but it's not so much. It still is trading around that 1 month lows. And if you look at the crude products, heating oil is at a 7-week lows, gasoline at a 1 month lows. The markets are reacting to the U.S. decline in inventories. But apart from that, the street does believe that with the Israel and Hamas ceasefire talks gaining momentum, that pressure could continue into the market. If you look at the last 1 week itself, the crude oil prices are down by 3.5%. It has been a huge pressure that we've seen in the metal prices as well. The gold and silver prices, while in the international markets, fell by 0.5%, but the Indian market saw a reaction to the duty being slashed. So we've seen 5% of a decline overnight in the Indian gold and silver prices. The base metal prices also have been taking it quite strongly. 3-month lows on copper. We've seen another 2% of decline onto this one. Iron ore prices are trading at a 1-month lows. Aluminum at a 2-month lows. So the strength in US dollar and, of course, the rising inventories, weak economic data from China, all of that has continued to weigh in for the metal prices. So after a weak June, the July seems to be going on the same set.
Okay, all right, Manisha, thank you very much for that. So that's what's happening as far as commodities are concerned. We'll take a quick commercial break here. On the other side, we'll have one of the biggest money managers in the country, S. Narain, Chief Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company, will be joining in to discuss what to make of the budget announcements and markets from here. Stay tuned.
Coming to personal income tax rates, I have 2 announcements to make for those opting for the new tax regime. First, the standard deduction for salaried employees is proposed to be increased from 50,000 to 75,000 rupees. Similarly, deduction on family pension for pensioners is proposed to be enhanced from 15,000 to 25,000 rupees. This will provide relief to about 4 crore salaried individuals and pensioners. Second, in the new tax regime, the tax rate structure is proposed to be revised as follows: 0 to 3 lakh rupees, nil; 3 to 7 lakh rupees, 5%; 7 to 10 lakh rupees, 10%; 10 to 12 lakh rupees, 15%; 12 to 15 lakh rupees, 20%; and above 15 lakh rupees, 30%. As a result of these changes, a salaried employee in the new tax regime stands to save up to 17,500 rupees in income tax. Apart from these, I am also making some other changes as given in the annexure. As a result of these proposals, revenue of about 37,000 crore, that is 29,000 crore in direct taxes and 8,000 crore in indirect taxes, will be foregone, while revenue of about 30,000 crore rupees will be additionally mobilized. Thus, the total revenue foregone is about 7,000 crores annually. Coming to personal income tax.
All right, welcome back. We're sort of counting down to the pre-open session. S. Narain is one of India's biggest fund managers. He's Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company. Naren, great to have you with us here. Thank you very much for your time. Prashant this side. I'm going to come to you. I just want to quickly play out this soundbite, and I want you to listen to this as well, because my first question is going to be that. This is Finance Secretary TV Somanathan on the revision in the taxation to 12.5% and 20%, and whether there'll be more coming in the next 6 months, that is the next budget in February. Listen in.
88% of the value of capital gains earned in India, according to our study, comes from people whose returned income is more than 15 lakh rupees. And 62% comes from those who are above 1 crore of returned income. So this is not a tax which is falling predominantly on the not at all.
Class,
and this is the class of income which Thomas Piketty and others have been writing about all the time. Now, at some point...
It then begs the question, are you looking at a higher rate? Because that's the worry, that you've done 12.5. This is perhaps an odd rate.
If we were looking at a higher rate, we would have done it.
But maybe you're testing waters with 12.5, and maybe
we don't believe in testing waters.
So is it going to be 12.5 now for the near term? I mean, for the next few years?
There is no intention to revise it from here. I cannot speak for all the future finance ministers and finance secretaries, but I can say as of now, we have no intention of revising this any further.
So 12.5 is...
Of course, no one can predict the future.
No, absolutely.
Somebody else may cut it too. I can't predict that. But what I am saying is we need equity in taxation. We can't say that only equity markets take risks and a person doing an MSME business is not taking risk and he should pay 39%. And because I'm taking stock market risk, I should not even pay 12.5%. There is a case for a lower rate on capital gains tax. It is much, much lower than the marginal rate of tax on other sources of income. And it's creating distortion in the savings markets also.
Naren, thanks for listening into that. So the assurance that it's going to be 12.5, not more. So I want you to react to that first before we get into markets, etc.
I think basically the markets can absorb it. That's why you would have seen yesterday that the market basically closed almost flat. And so from that point of view, I would say markets can absorb, equity markets have the capability to absorb at this point of time, given the kind of inflows that the market is seeing at this point of time. So I don't think there is a problem in equity markets because of a taxation increase. If the problem was there, we would have noticed it yesterday at this point.
And so it's done and dusted, right, behind. It's not as if there is some any lingering impact from here.
It's not that. See, we have to recognize where we are in the markets. We are in a market at this point of time where valuations are high, sentiment is exuberant, macroeconomics is fantastic. So and India is one of the best structural stories in the world for the next few decades. So the combination makes it very complicated, because do people look at the next few decades of structural growth and say, let's pay up for it? Or say India is one of the best macro in the world? Or people say valuations are so high compared to the rest of the world that you have to be cautious. Which of these things do you look at? It's a very difficult problem, particularly for a global investor. From a domestic investor point of view, people, I think, are not investing in debt at this point of time, because they're looking at the remaining two and saying that let's look for the long term. So that's why the government has done something more interesting outside equity, which is bring down the price of gold substantially, reduce the capital gains tax on real estate. So, we are not experts in these asset classes, but how do people react to that? How do people react to a big drop in customs duty and gold and drop in capital gains tax on real estate without indexation? It beats me. I'm not able to understand, because yesterday real estate stocks were down because capital gains tax on real estate was down without indexation. So this is something which maybe I can't...
Naren, so we were just discussing that before you came on real estate. Is it for legacy old property, this is negative? I mean, if you bought something very cheap 20, 30 years ago, and now you're going to pay it for, this tax without indexation. But for new property sales, isn't this, even if you buy something now and you sell after 24 months, you pay 12.5, not 20. Even if you bought at that point without the intention to sell, in theory, the taxation is now much lower. So from a stocks perspective, isn't it positive?
Yeah, even forget from a stock point of view. Today, for example, if I invest in a 2-year, in 2 years in one in our liquid fund or money market fund, you are in the top tax rate, you end up paying more than 33 or 38%. Whereas you invest in a property and sell after 2 years, you're going to pay 12.5%. There's a huge difference in taxation between investing in real estate and investing in debt mutual fund today. Is that something which is logical at this point of time, that debt mutual funds are the most hated asset class at this point of time? So I think slowly over a period of time, the government is saying do not invest in debt and invest in property, invest in equity, invest in these kind of asset classes, and that is what may happen, because slowly over a period of time, debt has become the only asset class where you are charged at the marginal tax rate, whereas both in property and equity, you get very, very favorable tax treatment at this point of time. So is that
okay, got that, yes. Got that. Hi, good morning. This is Sonia here. I was going through a piece that you had put out where you mentioned that now you're starting to get a bit cautious on the mid and small cap space, and across the board you are seeing a bit of fair valuation, slightly higher above fair valuations for the broader market. So what does one do now if you get a dip in the market? Do you think the best way to approach it is to stick to large caps and perhaps churn out of mid and small caps?
So actually, for the last 1 year, we've been cautious on small and mid caps. But small and mid caps have kept going up. And it reminds me of the period, we used to always come on TV and say FMCG, we are cautious. And FMCG used to continue to outperform. Then we have had a 3-year run between 2020 and 23 where FMCG underperformed the market 100%. So we seem to be into one of those phases where we continue to be cautious on small and mid caps, but small and mid caps keep going up. But what happens is, what we've seen is, when you have these accumulated underperformance of overvaluation, it shows up later. And when it shows up, you don't know. No one knows. But we are believers in asset allocation first. Then we are believers in flexi cap and large cap. That's how we look at it. Doesn't mean that today onwards, small and mid cap starts underperforming. The more it outperforms at this point of time, just like what happened in real estate between 2013 and 2020, or in consumer stocks between 2020 and a few months back, you can have long period of underperformance after the overvaluation. And we are not astrologers to know when the top of this FMCG or top of real estate will happen. If we knew, I would tell you, but I don't know.
All right. Hi, Naren. Good morning. Good to hear your thoughts and always good to see you in. Tell us your thought process now on some of these value buys. Energy fund has raised a fair bit of money. Stocks like NDPC, ONGC in the past have been quite positive on. What's the thought process from here on?
See, finally, at the end of the day, there are three things we depend on. We are dependent on moving from one place to another. So we need energy. Without power, we can't do this. Without telecom, we can't do this. See, we have always believers in this, but even these three sectors are not cheap. So the public has given us a lot of money to manage and given us a tough, responsible job on how to handle this market, because I wish these stocks were cheaper. So we'll have to handle this fund with the care that it deserves, given that public has given us the money. So it's a tough job. The challenge in the mutual fund industry is, 4 years back when the stocks were cheaper, we had to defend our investment in these stocks. Today, when the stocks are costlier, people have poured money and given us. So that is a tough job that we have, and how to handle public money in this area is one of the tougher jobs. But markets across the board are not cheap at this point of time. And we have a tough job grappling with all the money that we have and have to manage on an incremental basis. That is why we tell people be defensive, follow asset allocation, and that's the way to go. And it has nothing to do with the budget. I think it's a super budget. They have done exactly what is needed at this point of time, because in all areas where things can be borne. They have increased taxation. But there is no way in which you can have a situation where it means that markets are cheap at this point.
Okay.
All right, Naren, we need to take a break. But before we do that, I just want to quickly understand your asset allocation strategy. As you said, there's been some tinkering in taxes for equity, but the other asset classes as well, there's been some tinkering in gold as well as real estate. And asset allocation is going to be key. So what would your strategy be as of now?
So clearly, yeah, one should follow. In between, we used to think gold had gone up too much. Now, with this big drop in customs duty, gold prices in India have crashed. So what happens is, again, multi-asset kind of strategies become very, very interesting because of the drop in gold and silver following yesterday's sensible drop in customs duty. So I would say multi-asset kind of strategies are the par for the course at this point of time for long-term investing, where you do not put all your eggs in the equity basket alone and bet on all the asset classes at this point.
You want to give us a weightage for each of these asset classes if you're deploying fresh money?
These kind of things can't be done. It depends on individuals' capability. There is no such model which exists where you can apply one size fit models.
Absolutely. I know it. I mean, mornings are busy, Naren. Just requesting you to stay with us for a bit longer. We have to take a break, very quick commercial break, but see you on the other side with S. Naren.
Bihar has frequently suffered from floods, many of them originating outside the country. Plans to build flood control structures in Nepal are yet to progress. Our government, through the Accelerated Irrigation Benefit Program and other sources, will provide financial support for projects with estimated cost of 11,500 crore rupees, such as the Kosi-Michi intra-state link and 20 other ongoing and new schemes, including barrages, river pollution abatement, and irrigation projects. In addition, survey and investigation of Kosi-related flood mitigation and irrigation projects will be undertaken. Assam grapples with floods every year by the Brahmaputra River and its tributaries originating outside India. We will provide assistance to Assam for flood management and related projects. Himachal Pradesh suffered extensive losses due to floods last year. Our government will provide assistance to the state for reconstruction and rehabilitation through multilateral development assistance. Uttarakhand too suffered losses due to cloudbursts and massive landslides. We will provide assistance to the state. Recently, Sikkim witnessed devastating flash floods and landslides that wreaked havoc across the state. Our government will provide assistance to the state.
Market open. Naren is still with us. Naren, thanks for waiting. I just want to sort of press upon the debt mutual fund aspect just one bit longer, because, I mean, you've been kind of championing how debt has been ignored as an asset class. Everyone is piling in into equities, and now you got this, as you also said. You said, well, the indication seems to be from the government that don't invest in debt. Invest in gold, real estate, maybe stocks, of course, with higher tax even, but debt, it becomes very unattractive in that sense. Would you agree, Naren? And would you see shifts in terms of flows from investors?
I don't know. I think inadvertently this seems to have happened at this point of time. I don't know what is the situation, I think. But I don't think it was a planned thing, but government, whether it's a government, what's happened, it's very difficult. But right now, for us, for example, we are not able to convince any of our investors to invest in debt mutual funds. They are very, very equity focused at this point of time. That's what we're seeing at this point of time. So, but what we have seen over a period of time is debt plays a very important role in every person's asset allocation. So instead of focusing on debt, we have to think of getting them into asset allocation strategies or hybrid strategies at this point of time. And that is what we try to get people to do at this point of time. And
convincing them now is going to be even more difficult.
No, it's not that. See, our view is, basically, there has to be a bit more volatility in Indian equity. If there is no volatility in Indian equity, people think that why look at debt? The day we see, we've got 10, 11 years, thanks to fantastic macro management by the government of India and Reserve Bank of India. What has happened is we have not seen much of, we have not seen much of movement of markets downwards. So you have not had a down year for so many years in equity. So people have come around to this view that equity is a safe asset class without risk of a downward move. I think the year there is a downward move, I think that will come back. That is how we look at it. But right now...
got it. Just one more, I just want to press this in. Rural allocation from the government. I take your point on the volatility bit. Rural allocation for the rural sector is down once again. I think it's down for the last 5 years. Every year it's down. So there was some expectation that at a mass level, rural, etc., there'll be that support from the government. It's not happened at all. Just your thoughts on any bets that people have been making and any implications for stocks.
I'm not an expert, because if you look at the way MNREGA allocations have been going up and a lot of indirect things that are happening, for example, most of the road construction that happens through the highway programs in various ways, even the expressways happen in rural areas. So how you count the rural allocation is a bit of this thing. If you look at the way, if you talk to most of the construction companies, they tell you it's so difficult to get labor at this point of time. So, I mean, it's very difficult to correctly predict what is the amount of money which goes to rural area directly and how much goes indirectly. So I think it's not fair to the government to say rural allocation is not there. It goes through direct channels and it goes through indirect channels. And that is how we see it. And maybe that is just looking at just some rural indicator alone is not the way to look at it.
No, I completely take your point, direct and indirect. But the printed number is what I'm going with. So that is down. That's what I meant. Naren would have sort of lots of other points to discuss, but we are completely out of time. And you have a very busy morning as well. So thank you very much for being with us here on CNBC TV18. Thanks for your time here. Thank you. As always. And good chat. We'll take a quick commercial break here. We are back with a pre-open session. We'll also be joined by Mitesh and Sudarshan, trading ideas from here. That's coming up.